All right, everybody, welcome back to Understanding Your Economic Engine. This is Product Profitability, Part B. If you have not watched Part A and worked the problem, stop now and go back, because this will be far more powerful for you to have worked this problem yourself. All right, so we are in the midst of trying to understand how much money our factory can make. And the first question we would seek to answer is, can we produce everything that's possible? So all 100 Ps and all 50 Qs. So we have a demand for 100 Ps, 50 Qs. The revenues are $90 for Ps and $100 for Qs, giving us a total revenue of $14,000 potential. We have material costs of $45 for Ps times 100, $4,500. 50 Qs at $40 a piece, it's $2,000, gives us a total material cost of $6,500. Cost to run the factory, all labor and overhead and energy and all that good stuff, is $6,000. Gives us a potential net profit of $1,500. This is one of the three probable answers that folks got. So some people didn't test to see if they can make everything and got $1,500. If you're one of those, let's look at what's limiting this factory. Can we make all 150 units? So let's make a little chart here of total minutes required. And so for A to make a P takes 15 minutes and Q 10 minutes. For B, it takes 15 minutes and 30 minutes. See, because both Y's and Z's are processed in the Qs in section B. C's 15 minutes and 5, and D's also 15 minutes and 5. So if we look at it, we've got 2,400 minutes in our factory. That means, oh, we got a problem at processing center B. There is not enough time. We have the need for 600 more minutes than we actually have. So we can say process B limits our factory's ability to make money. It's the system's constraint. Right. So now the question is, should we make Ps or Qs? If you're going to answer this question in your business, you would probably go to your financial person, your controller, or your accountant, and they would give you some information. And this is the way they would typically arrange that information. They would look at their labor costs, and we didn't tell you this information because it wasn't necessary to solve the problem, but laborers cost $400 per week per operator. There's 4 operators at A, B, C, and D, so that's $1,600 of the $6,000 is actually going to labor. So each laborer is working for 240 minutes. That equates to 17 cents a minute. So our labor cost is 17 cents a minute for all 4 employees. Now, if we have 1,600 of our 6,000 is labor, that means our overhead is 4,400. And 4,400 divided by the 240 minutes times 4 processing centers is 46 cents a minute. So we've got a labor and a burden rate. And then we would look at each product and say, well, there's 60 minutes of factory time taken to produce Ps. 60 minutes times 17 cents for labor and 46 cents overhead gives us $37.80. Plus material costs, which are 5 plus 20 plus 20 is $45, gives us a cost to produce each P of $82.80. P's profit, therefore, is $90 in revenue minus $82.80 in costs is $7.20. All right. P's profit margin, therefore, is $720 divided by 90. It's 8%. Right. So that's the way accounting would typically look at this problem. Q, similarly, 50 minutes, $71.50 in time and materials. The profit, therefore, is $28.50 for 28.5% profit margin. So Qs on the surface here look a lot better than Ps. Let's organize this. From a revenue perspective, if we were prioritizing Ps over Qs, well, we'd like more revenue rather than less. That means we would prefer Qs. All right. From a material cost, if we were just going to decide P's or Q's based on material costs. We'd like to tie up less of our money, not more of our money. So Q's require less material costs. From a gross profit standpoint, we make $45 on P's and $60 on Q's. We would prefer higher gross profit. From a labor minutes, we prefer lower labor minutes. Q's again. From a profit standpoint, we like to make more profit, not less profit. Q's again. Profit margins, we like higher profit margins, not lower profit margins. Q again. All right. So very clearly, our factory should be prioritizing Q's over P's. Right. So let's take a look at prioritizing Q's. We have 50 Q's at 1,500 minutes, leaves 900 minutes for Q's, which means we can make, for P's, which means we have 900 divided by 15 minutes at B, gives us ability to make 60 P's. All right, so that gives a total of 240 minutes. So 60 P's and 50 Q's gives us a revenue of 10,400. The material cost extended is 4,700. The cost to run the factory is 6,000. Our net profit is negative $300. So prioritizing Q's, our factory loses money. This is the second most common answer, or a second common answer. If you didn't bother to figure out that there was a constraint, you ended up with 1,500. If you went through the math and figured out Q's are a better deal than P's, you would end up with minus $300. Of course, there is another alternative. I'm a Quaker by background, and we're peaceniks, so let's give P's a chance, folks. We would have 100 P's at 15 minutes, and B would be leave 900 minutes for Q's. 900 divided by 30 minutes lets us create 30 Q's. So we can make 100 P's and 30 Q's. And the revenue extends out to $12,000 in revenue. Material costs are $5,700. And the cost to run the factory is still $6,000, which, by the way, gives us a net profit of $300. Isn't that interesting? All right. When we prioritize Q's, which everything in cost accounting would tell us to do, we lose $300. When we take the less favorable P's, we make $300. If you came up with minus $300, oh crap, maybe you really do have blinders on. If you came up with the $300 because you prioritize P's, congratulations. You learned something from the first 4 iterations of understand your economic engine. So let's take a second and look at how this comes about. All right. So back to our factory model from the first 4 vlogs here. Really, we're concerned about what constricts the flow of throughput dollars. All right. And that's processing step B, right? And the essence of profound insight is simplicity. The plant really comes down to what's going on at B. And P's have $45 of throughput dollars, right? That's revenue minus cost of goods sold, which in this case is simply $45 material costs. So $45 throughput dollars divided by 15 minutes processing time at B means that P's are allowing throughput dollars to flow into our operating expense tank at a rate of $3 per minute. Q's, on the other hand, while they have a higher throughput dollars of $60 per part or per piece, they take 30 minutes at B. And so they're only generating throughput dollars at a rate of $2 per minute, right? And so there is the big difference, right? We mentioned this and alluded to this in the quoting vlog 1 or 2 ago, that this is the way to figure out, the quoting process to figure out which products, how much you need to make per product. And that always is determined by your constraint in the plant. All right, so what went wrong with our analysis? Well, we didn't factor in the fact that B was our factory's constraint. And the one thing that really matters is the rate of throughput dollars. and throughput dollars per minute at B are $3 versus $2. It's a 50% increase, right? P's are clearly the more profitable product to make, despite what all the cost accounting numbers would tell you. It is the only measure of relative product profitability that matters. So, how many of you know, or do you know, this number for your plant's product mix? If you don't, you got a little bit of homework to do, don't you? My name is Rick Phelps. I'm an action coach and can be reached at rickphelps@actioncoach.com. My website is phelpsltd.com, and my cell phone, which will ring directly to me, is 216-533-1387. Please reach out. Let's have a conversation if you'd like to learn more about how to apply these concepts in your factory. Have a great and profitable day.